What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we are going to be doing some stock analysis for Shift4 payments. This is a stock I just found out about this past Friday. My friend texted me about it, and I spent about a couple hours researching it. And I said, okay, I think I'm going to take a chance with this one. So I bought 20 shares at $68 a share. And I said, okay, there's a couple things that I like about this company, and there's a couple things I don't like. So, what I do like about the stock and investing in it is that the stock is down to a point where it was pretty much trading at 5 years ago, and it really hasn't done anything in the last 5 years. It's had some ups and downs, but it's back down to being where it was 5 years ago. So there's that paired with the fact that their revenue has drastically improved over the last couple of years, right? 5 years ago they did $1.3 billion in sales. Now they're doing $3.6 billion in sales. The net income has gone from negative to up to $220 million of net income. Free cash flow, same thing there. And the numbers just look better. So that's what I do like. What I don't like is, for one, this one's not a huge deal, but the cash to debt is not great. It's just they're both at 3 billion, so it's not great, but it's not bad. It's just in the middle. Then we have shares outstanding, and this one is also not great just because it's, from 2024 to 2025, there was a big jump in shares outstanding, which that happens a lot of times with newer companies or startups. So it's kind of to be expected, but at the same time, it's not helping the stock. Then, I mean, you look at the valuation, we're looking at a forward PE of 11, which that actually is, again, it looks incredibly cheap compared to where it's been the last couple of years. So there's that. One thing I don't like is when you really look at their business model and what they do, they're just like a payment processing company, which a lot of other companies do that. So I was kind of looking for a moat, or how is this company going to take market share? What are they doing differently than PayPal and Shopify and Venmo and Block and all these other companies? Well, they're really not doing anything different. They're just, what's nice about them is they're growing sales, they're taking some market share, and they're targeting certain markets like hotels and stadiums, to where pretty much what they do is they make it really easy to have a software that can track and monitor you bringing sales in from multiple different ways at your location or your facility. So if you own a hotel and you're selling five different things in five different places, well, it helps them pretty much integrate it all into one platform or one software. So I do like that. And again, that's why I didn't make this into a huge position, just because I'm not super, I don't really see where this is going to be a huge growth stock. Just because until they're doing something very different that's going to make them, steal a bunch of market share, it's probably just going to consistently grow just a little bit. And then one of these other companies could buy them out. I could also see that happening, as I could see a PayPal or a Google buying them out, which really, if you're an investor, that could be a good thing, because a lot of times they're going to buy it for a premium and you will make money on that. So there is that. But I mean, again, it's a $6 billion company, and they're doing what, $200 million in net income, and their sales is going up to over $3.5 billion. I like that. Then let's look at what analysts have them doing, and we're gonna see what, $4 a year ago to 5.5 this year, and then almost 7 next year. That's the other thing I really like, is analysts have very high expectations, and they're supposed to grow EPS quite a bit going into this year and next year. So I really like that, because if they in fact do these numbers, then I mean, $70 a $70 stock should be like the bare minimum for this company. Like that should be it. Worst case scenario, I think the stock is $70 in a year from now. So I really do think this stock could probably double in let's say in a year or two. I could see the stock being double, because look, I mean, look, if their EPS actually does this, if their EPS goes from 3.8 to, let's say, a 7, well, then yeah, this stock should be well over $100. And I think that's a pretty fair risk to reward to take on. So am I going to make this 10% of my portfolio? Well, no. But will I add a couple more shares to this? It's possible, because it just looks like, wait, why does it do that now? Yeah, okay. So the stocks has come down a lot. The valuation's cheap. Their numbers look good. Has the net income been super consistent the past couple quarters? Well, no, but it still is from where it's been the last couple years. It's in a much better spot, and I think they're acquiring a lot of customers. They have a lot of different clients in hotels and, like I said, stadiums. So you know, I like what I see. I think it's fair to make an investment this at in a small as a small percentage of your portfolio. I'm really excited to see if they actually hit these EPS numbers. And then the other thing I like is if you come down here, you can see that there was a big insider purchase, alongside Robinhood investors and hedge funds. There was a big insider purchase, if it'll actually let me look at it, which is right. Let's see. Right here. Yeah. So in August, there was a what to get with those together, that was a what $16 million investment. And that was at 80 $83 he bought the stock. Okay. And now the stock is 70. So I'm getting at a much better deal than him. So that also makes me confident because if he put $16 million in there, that's quite a bit of money to put into one stock. So that's kind of the way I'm looking at this. And yeah, I'm interested to see where this goes. I think the financials are pretty decent here, so we will see what happens. But thank you for watching, and I will see you in the next video.